Hello students, having completed the first part of our chapter 9 financial management, now let us move on to the second part of financial planning. In first part we revised the three financial decisions, that is investment decision or capital budgeting decision or long term investment decision, second financing decision, and third dividend decision, along with the factors affecting all these three decisions. Now, financial planning is essentially the preparation of financial blueprint of an organization. It ensures that the enough funds are available at right time, and if the adequate funds are not available, then the firm then the firm does not uh, you know uh, may not be able to honor its commitments and carry out its plans. So, financial plan takes into consideration the growth, performance, investments, and requirement of funds for a given period of time. Financial planning is the process of estimating the fund requirements of a business and specifying the sources of funds. Let us remember here that financial management is the part of financial planning. It means financial planning has a bigger umbrella covering financial management along with the questions of raising as well as investing the funds. So it involves two types of financial planning, long term as well as short term. Long term plans have capital expenditure programs for long term growth and investments, while short term financial plans involve day to day business operations in the form of a budget. If you remember, budget is also a type of plan. The budget is a statement which is expressed in numerical terms and that normally is prepared for 1 year. The preparation of budget starts with the sales estimation or sales forecast, and then gradually we arrive at estimated profit or estimated cash flow, so that we can decide how much amount of funds shall we be needing from other sources other than the retained earning or reserves. Objectives of financial planning are important and it's a frequently asked topic in the exam. So there are two objectives of financial planning. Remember that objective of financial management was only one, that was maximization of shareholders' wealth, while here the objectives of financial planning are two. Hence they are known as twin objectives of financial planning. The first is to ensure availability of funds whenever required. So estimation of funds is required for different purposes such as purchase for long-term assets or to meet day-to-day expenses of business, and also estimation of the time at which these funds are to be made available and specifying the source of these funds. Second objective is to see that the firm does not raise resources unnecessarily. So if excess funds are available, it will unnecessarily increase the cost and the resources will remain idle, or it may encourage wasteful expenditure which is not at all good for the financial health for the company. So two objectives: first, to ensure the enough availability of funds whenever required, and second, that to make sure that our first objective is fulfilled, we do not overlook the second objective wherein we raise unnecessarily resources and then those resources remain idle. The next point is importance of financial planning. Now this answers a very crucial point of why should overall planning of any business enterprise should aim at enabling the company to tackle the uncertainty in respect of availability and timing of funds. So the importance of financial planning can be explained in few points. First being helps to forecast. Now financial planning tries to forecast what may happen in the future under different business situations. So this forecast is made generally based on the past data. So for example, if a growth or in terms of sales turnover is estimated to have increase of 20%, but it may happen that eventually it turns out to be 30%, that is plus 10%, or 10%, that is minus 10%, 20 minus 10. So these three situations will have to be worked out in order to prepare the blueprint of the financial situation of our future condition, because we have to prepare for all the types of situation. So if our estimation is 20%, we may prepare for 10% and 30% as well, so that we can tackle with any unknown situation in future. Second, it helps to absorb business shocks and surprises. So blueprint of an organization prepares an organization to have to make it capable for absorbing any shocks, like the shock that this pandemic has given to us, or the surprises means any positive opportunity which can be encashed to generate some additional profit. So financial planning would also maintain some margin for negative as well as positive sides thrown by the environment. Helps in coordination. So financial planning helps in coordinating different functional areas of business. For example, sales and production functions by providing clear policies and procedures. The next is a detailed plan of action prepared under financial planning reduces waste, duplication of efforts and gaps in planning, because as we know that planning is a mental activity. So a top management normally plans for the financial resources of any business and entity. So here detailed plan of action is prepared so that we can reduce duplication of chances, or we can reduce the wasteful activities in terms of fundraising or fund investing activities. Next is it links the present with future. So it provides a link between your investment decision, that is how to procure the funds, and financing decision means where to invest these funds on a continuous basis, as we know that planning is a continuous process, and so it goes well with the financial planning as well. Then comes it enables a company to tackle the or to evaluate the actual performance easier by spelling out detailed objectives for various business segments. So if we have a budget, that is a rough financial plan ready for one particular division of a firm, then at the end of the year or in the middle of the year we can have the controlling process better, means to see that we are going according to plans or are we deviating. So to measure this performance amid any kind of plan, amid any kind of situation, it is very necessary to have the benchmarks with us. So financial blueprint would serve as a benchmark for evaluation of performance in the future. Now the third part is the capital structure decision. In this is the third part of the chapter. We would study the meaning of capital structure. We would also revise the EBIT EPS analysis, factors affecting to it, as well as the fixed and working capital requirements of a business along with the factors affecting to them. I am sending the new video for explanation of this new topic.